Mike Aronstein, CEO of Marketfield Asset Management, says commodities are poised for a 5 to 10-year bear market. And why do we care what he has to say? Well, he predicted the commodity slump in 2008. He was right. Mike, good to have you back with us.
Thank you for having me.
So a bear market, what's out there that tells you that that's where we're headed?
Well, I can't say precisely, but I think you've got a lot of these commodities in the hands of people who own them, not because they need them or use them, but because they are counting on somebody else to take them off their hands at a higher
market,
price.
Are you talking about? Or?
Yeah, we're 10 years into this process. The commodities bottomed right around the beginning, around the turn of the century, really. And, people have looked backward at the trend and now have a notion that that's a good predictor of what the future is going to look like. And certainly it's been a wonderful 10 years to have money across the commodities complex. But you're at a point now where prices are high enough that you really require a tremendous amount of inflow, just in dollar terms or in yen terms or in euro terms, in order to maintain the price level. It's almost like inertial mass. As things get faster and faster and larger, it's harder to accelerate them. And the aggregate value of commodities traded now at current prices and the current distribution of futures, forwards, and other contracts is enormous.
So you think that global growth, although you're fairly bullish on global growth and emerging markets, but you think that's priced in and then some in the commodities prices that we're seeing?
Yeah, I think actual demand, actual usage does not move as rapidly as the price rise would suggest. I think you've gotten to the point in a lot of these commodities where supply is going to catch up. You've had a lot of capital investment. You're going to get a lot more capital investment in the next year or two. It's already underway. And I think you've substituted speculative demand, which is using the fundamentals as a rationale, sort of ex post, for what began as a soundly fundamental process.
So even with 8 to 10% growth in China, even with big growth in India, more people moving into the middle class and buying refrigerators and air conditioners.
There's enough supply out there without prices?
There's going to be, and the supply, the shadow supply, is what's in the hands of all the speculative community. If people who are sitting there with corn contracts and cotton stored and all the others, if they decide that maybe this isn't the most fertile ground for investment, they become, in effect, producers. They become an incremental source of supply, and it can happen. It's exactly what happened in the housing market.
Do you have no exposure at this point then to commodities, Mike?
No.
None at all?
No. It's certainly not helped us. Over the past several months, we've missed the party.
But
we left the bar 2 hours before closing time, and that's when all the fun started.
But you don't want to go back to the bar. You don't want to change your mind.
No, this is one of those areas in which I think you're developing enough tension so that there's real risk. There's a risk of permanent impairment to capital, not just a risk of correction. And 10 years into the mission in anything where prices have risen this much and the fundamental story has become as widely disseminated as this one has, and people are that confident about it. This has become more or less a mainstream mom and pop type of asset class. That's when dangers arise. When you have that level of expectation that's embedded throughout the ownership base, and it's in an entity, people have no practical use for any of this. The people that own the majority of these instruments. They don't own them because there's a utility value.
So when do they release them back in?
When they get tired of them. It's sort of when do people give up on second homes as a good investment?
Or when they can't buy them on the margin, right? I mean, what do you think about COMEX's move to raise margin requirements for silver 4 times in the span of like 1 week?
Well, they're trying to dampen the speculative
Is that all that was
fever
behind that?
And listen, Matt and I are going after because there's a story kicking around about.
Let's just say that some people have been talking about price control with margin requirements.
Well, it's a de facto, certainly. It's a big influence on prices as they're set in the futures market. It's one, certainly, commodity trading through the medium of futures and forwards is one of the most leveraged. It's not as leveraged as house buying was 3 years ago, but it's extremely leveraged. And that may be one of the expressions that you're seeing of the quantitative easing policy and the expansion of the Federal Reserve's balance sheet it makes it much easier for these big multinational financial institutions to fund people who are trading, and that means trading anything. But in stocks, there's Reg T. You can't go out and margin your stock positions 20 to 1 or 50 to 1. Whereas in foreign exchange and commodities, the leverage available is nearly limited. So that's a consideration at this point. And it's been a wonderful market, and I do not deny that. But what I will say is, history is not a great guide to prospects for the future. They're two different things.
Got it. We got to run. Mike, thank you so much, though. Mike Aronstein of Marketfield Asset Management. Thanks.